David Smith from Frost Financial Planning here. I want to talk to you today about investing in residential real estate. Now, lots of Australians have done that over the years. Some of them have made money and some have lost money. So we'd like to share some things with you that we think are important if you're looking at purchasing an investment property. The first thing is that property should only ever be considered as a long-term investment. And in financial planning, we think of long-term as 7 years plus. There are two ways you can make a return from residential real estate. One is from the rent and the other is from capital growth. Now, capital growth is really, really important because over the long term, that's likely to generate the majority of your profit for you. And you have probably heard the term location, location, location from real estate agents. It's actually very, very true. The location is an important driver of both capital growth and the likely rental return. So look for things like being close to critical infrastructure that's going to appeal to tenants. Shops, public transport, schools, hospitals, all that sort of thing. And look for areas that have a number of economic drivers. And by economic drivers, we mean activities that are creating employment opportunities for people. And abilide areas that are dependent on a single industry or a single project, because when that industry comes to the end of its life or the project comes to the end, demand for rental properties is going to decrease, prices may well decrease, and it may be difficult to find a buyer for your property. And never ever assume that you can sell a property quickly when you need to. When markets are soft, there are going to be many more sellers than buyers, and you're going to become a price taker, not a price maker. The power is not in your hands in markets like that. That can actually lead to a capital loss rather than the intended capital gain when you purchase the property. You've probably also heard of negative gearing, which is a tax issue. Property offers some tax advantages, depending on how it's structured, but never ever make an investment decision based on tax outcomes alone. It's a big, big mistake. The investment itself should be worthy of your consideration, even ignoring the tax advantages, because at the end of the day, you want the investment to make money. There's not much point saving $1,000 a year in tax if the value of your investment is going backwards by $5,000 a year. That just doesn't make any sense. Now, paying market value for an investment property is really important. If you were, say, going to buy some BHP shares and you wanted to know the market value of those shares, it's a very simple exercise. You just log on to the ASX website, see what they're trading at, and you know the market value. It's not that straightforward with property, and there are a few things to be aware of. First, be wary of purchasing in markets that you're not familiar with, because even very inflated prices in those markets can seem cheap compared to your local market. So you really need some local knowledge. And also be very, very wary of property developers who might be offering you something like an initial 2-year leaseback period. Because let's just say the real rent for a property you're looking at is $400 per week. If the property developer is offering to lease it back from you for, say, 2 years at $500 a week, then that pushes up the theoretical value of that property, and you could end up paying a higher price for the property based on the elevated rent. Now, after 2 years, if the rent comes back down to where it should be, you've got your property valued at less than what it was, but has your loan value gone down? Now, the answer is no. So just be wary of those things. Also be aware that any borrowing for any investment involves increased risk. And if you are going to do something like that, your circumstances are obviously changing. You should be having a serious think about whether you need life insurance and income insurance as part of your purchasing strategy. Also be aware of unique local factors. So in Australia, we have some areas that are very prone to bushfires, some that are very prone to floods. That can affect things like insurance premiums on properties or whether the property is in fact insurable at all. So just be a little bit wary of local factors. Before you even go shopping for an investment property, you should have thought about who is going to own the asset. Now, should it be you? Should it be you and a spouse? And if it is going to be you and a spouse, should it be joint tenants or tenants in common? Or do you even understand the difference between those two? You could purchase a property in a trust, so something like a family trust. You could also create a company, an investment company, and purchase in the name of the company. Or you could establish a self-managed super fund and purchase a property inside that vehicle. Now, we're not suggesting any of those to you. They all have different merits and they provide different outcomes for things like estate planning and tax planning. But you really should have given thought to ownership before you even go out looking for a property. Now, if you're out shopping for a property, you're likely to meet a real estate agent. And a real estate agent's job is to get you excited about purchasing the property you're looking at. They want you to purchase with your emotions. And if they manage to achieve that, give them a pat on the back because they're doing their job well. They're a good real estate agent. But remember that they're working for the person selling the property usually. They're not working for you. A good financial planner's role is to remove emotion from the investment making decision. Our role is to make sure you purchase with your head, not your heart. Now, a property investment, like any investment, really should form part of a structured financial plan. It shouldn't be an off-the-cuff thing that you do. So, should you purchase an investment property? Well, that's a really important question. To find out more, or to obtain a copy of our brochure on this topic, contact our office or visit our website.